Well, let's take a deeper look at markets, and I want to bring in my guest, Katie Kaminsky, Chief Research Strategist and Portfolio Manager at Alpha Simplex. Katie, thanks so much for joining the show today. We see kind of a breather in stocks. What do our viewers need to know?
Well, it's been a very interesting week because people have been looking for retracement in the equity markets. And I think there are a few things to watch. Number one, look at the price of oil, look at commodities. They bottomed in February, they're starting to tick up. It's making people concerned. Second of all, bond signals tend to be short right now, meaning that yields are in some sense expected to go up and they're very close to a breakout point. So this suggests that the market is really trying to digest what it means to have higher for longer if we don't have as strong expectations of as many cuts this year for central bankers.
How do you expect this playing out over the year? Perhaps some short-term volatility you mentioned as investors have to digest what's going on. But do you think this rally can continue?
Well, clearly in yields, we're very close to a point where we could be breaking out. I think we've been looking for a pullback in equities, and we've seen such a strong quarter last quarter. So it's not surprising that you might see a little bit of a retracement, a little bit of take profit. But of course, the real question is how much did the stock markets bake in more rate cuts? And is it finally actually going to have an impact on stock valuations at this point? Should we have to wait a little longer to have cuts at this point?
hmm So, in terms of a pullback, are we talking a minor correction here, 5 to 10%, or do you think something potentially more dramatic?
Well, I think it'd be a little quick to say that this is going to be something dramatic. It may just be a simple repricing of expectations in the sense that inflation data has just been coming out more sticky, which just says you have to wait longer for things to see rate cuts, which the question is how much did that get priced in? Probably a few percent, but we'll have to see something more severe, I would expect, to actually see a stronger retracement in the equity market at this point.
So, with the bias or the momentum to the upside, it seems like, after perhaps a readjustment of expectations, how long do you think this rally can last? Or maybe put another way, at what point are we in this cycle, insofar that investors can get a better sense of what they should be doing with their money over the next 6 months, 1 year, maybe even 18 months?
See, this is a very good question because in the short run, we need to digest what it means to wait longer for cuts. So I do expect there'll be some volatility, a possible retracement. Over the longer run, it's really going to depend on if we see more deterioration at some point in economic data or if we see some indications that these higher rates are detrimental to the stock market. So far, the stock market this year has really not indicated that. So that's what I would watch out for is if you start to see earnings be more sluggish, if you start to see companies being challenged with higher rates, that would be a stronger indication that we might have a bigger pullback. But if we can navigate this period, I think that there's definitely still some potential upside in equities on the longer term this year.
Interesting. Commodities. I've seen a lot of action in oil recently. Talk to me more about what you're watching in commodities and how we should view that.
So commodities are very important to watch in these type of turning points. The reason for this is that commodities are often a lead indicator for a potential breakout or change. And what you've seen recently, I think Brent is close to 89 today. And so you're seeing commodity prices bottoming in February and starting to tick up. Take a look at copper prices as an example, or gold. You're really seeing an upswing in terms of commodity prices, which will eventually percolate through and be a potential tailwind for inflation or a headwind for cuts earlier than we might expect or earlier like we would like to expect. So the sense is you got to pay attention to the commodities because volatility there and increased prices is just going to put more pressure on the lower inflation narrative. And so we have to wait longer for rate cuts.
Interesting. So the Fed's long-term target for inflation is 2%. But as we saw with the Fed's preferred inflation gauge on Friday, it was 2.8% in February from the same time a year ago for the personal consumption expenditures index. Do you think getting back to 2% is something feasible on the horizon, or do investors and Americans need to perhaps get more familiar with inflation that is a bit higher than 2%?
Yes, I think we all want inflation back at 2%, but the reality of getting inflation down to 2% is going to probably take longer than most investors would like. What this means is that there's really less need for rate cuts, which is what most investors want. So they want to have lower, interest rate payments and things like this. But if we're still seeing inflation above target, there's less of a hurry for Fed officials to really sort of go ahead and cut, because then they're putting, if inflation's high, they cut rates, that puts long-term bonds at risk, because high inflation with lower rates means that long-term cash flows might be more vulnerable. So that is what I would be watching in terms of looking at the yield curve, paying attention to the long end, as we see, if we do see cuts.
What else do you think investors need to know as we start the second quarter?
Well, I think it's a tricky period for investors right now because we've seen such substantial gains in the equity markets. It's hard to know, is this a point to enter the market? Is this a point to see where you can find some diversification? That's why I highlighted some of the opportunities that are in the case of sticky inflation. So things like short bond exposure, which benefits from yields going up, things like commodity exposure, which potentially could benefit from an increase in commodity prices and sort of a second wave of higher commodity prices. Whether or not it's as big as what we've seen, it's still a potential opportunity set in an environment where equities are hard to navigate when they've been up so much and valuations have been so high.
You know what I'm gathering here too is we have to remain data dependent. It sounds like, based on your thesis, of course, investors, I think, encouraging, sending a signal to the Fed that they want the Fed to cut rates. That is, but obviously still very much a fluid situation. It sounds like, is that the stance that your firm is taking as well?
Yes, I mean, as you're saying, it's really, we need to have more data that we're getting to target. We need to see data that confirms that we actually need lower rates. I think we all want them, for clear reasons, but it's going to take time to get to that point. So we need to keep watching the data. And right now, the data is coming out stronger and firm and steady. And inflation related assets, such as commodities, are on the uptick, which is sort of a tailwind for getting to the soft landing we want sooner rather than later.
Katie Kaminsky, Chief Research Strategist at Alpha Simplex. Thank you so much for joining.